Gold has hit a massive fundamental crossroads, and the next big directional break is about to be triggered. After plunging to a definitive 8-month baseline low of $4,203, early in June, a painful 27% correction from January's all-time highs, bullion has staged a ferocious $300 relief rally, climbing back above the critical $4,300 mark. But as macro traders face a high-stakes tug-of-war between $40,000 and $4,500, the big question remains, does this recovery have real legs, or are we tracking a giant central bank trap? The immediate fundamental backdrop is a brutal clash between fading geopolitical fear and aggressive monetary tightening. Gold's sudden $300 rebound was heavily fueled by a sweeping relief wave after the United States and Iran electronically signed a landmark peace framework. This historic treaty completely erased the immediate war premium and guaranteed the reopening of the strategic Strait of Hormuz, driving crude oil down over 5% and dragging the global safe haven dollar index sharply away from its multi-month highs. But just as the bulls tried to capitalize on that weaker greenback, the Federal Reserve stepped directly into the arena to cap the commodity's upside. Under the leadership of the new Fed chair, Kevin Warsh, the central bank held interest rates steady at 3.5 to 3.75%, but dropped a deeply hawkish policy bomb on Wall Street by completely stripping away their previous easing bias and raising their year-end Fed funds rate projections to 3.8%. Policymakers sent an unmistakable message to the markets. Bond traders reacted instantly, aggressively spiking December rate hike probabilities to nearly 85% and pushing Treasury yields higher. Because physical gold pays an absolute zero yield, this higher-for-longer regime dramatically increases the opportunity cost of holding bullion, giving institutional short sellers a perfect fundamental excuse to defend heavy overhead resistance walls. From a purely technical perspective, the lines in the sand are beautifully defined on the daily charts, establishing two highly asymmetrical scenarios for swing desks. The bullish case for $4,500 to sustain this $300 recovery and launch a massive breakout toward the $4,500 milestone. The bulls must completely clear and hold above the major technical pivot zone of 40-3-100-100-60-$5. If institutional buy volume can flip that level into a solid support floor, it will confirm that structural central bank accumulation led by 18 consecutive months of massive buying from the Easter's pudding, a permanent floor under the market, opening the floodgates for a massive squeeze back toward the 200-day moving average. The bearish case for $4,000. On the flip side, if the hawkish reality of Kevin Warsh's Federal Reserve keeps Treasury yields elevated, this relief rally will rapidly exhaust itself. A failure to clear $4,350 will confirm that the short-term buyers are completely spent. If the bears force a break back underneath the immediate support zone of $4,300, the descending channel structure remains firmly intact, exposing a fast microwave decline straight back to retest the major 40-2-100-100-3 baseline low. The macro reality. Gold is caught in a violent squeeze between a melting geopolitical war premium and a fiercely restrictive Federal Reserve. The technicals have set the stage, but the incoming inflation data and central bank rhetoric will completely decide who wins this high-stakes battle. Will this historic Middle East peace deal propel gold into a sustainable $4,500 breakout? Or will the Fed's hawkish rate path crush the recovery and force a deep drop back to $40,000? Make sure you do not get caught on the wrong side of this massive macro pivot. Hit that subscribe button right now for daily, fast-paced insights and breaking commodity updates.